Hey, I'm Vishnu Srinivas, and you're listening to the Hawkeyed Podcast. Joining me today is Palak Patel, author of The Tyranny of Nations. Thanks so much for joining me today.
Thanks for having me.
So would you like to give a short introduction about your background and your role?
Sure. So as you mentioned, last year, I wrote this book, The Tyranny of Nations, How the Last 500 Years Shaped Today's Global Economy. Presently, I'm a macro investor. I use a hybrid mix of quantitative and macroeconomic analysis for a top-down investment strategy. And prior to that, and prior to writing my book last year, I spent 9 years at Fidelity Investments in their emerging markets team, using top-down macroeconomic analysis to invest in bonds, currencies, and country equities indices.
Awesome. Yeah. So that's kind of like the direction I want to take us in today. Because, I was talking with David Levy on a previous podcast, and he told me that, even before, the Russia-Ukraine conflict, emerging markets were the area that he felt were the most vulnerable right now. And I'm curious, like, what your take is on that statement, and what do you generally feel like the biggest risk factors for them right now?
I think there's some merit to that. Emerging markets are in really bad shape. They've been in bad shape for a very long time now, since 2013. The past 4 or 5 years, and sort of what motivated me to write my book, actually, was this feeling of experiencing slow motion subprime in EM, especially EM debt, where you'd see country after country. It started with Venezuela, then you had Ukraine the first time in 2015, Zambia, Argentina, slowly more and more countries going from investable to uninvestable. Their country spread, the interest rate over treasuries blowing out, and just this week we've seen Sri Lanka and Tunisia come under debt stress. So yes, emerging markets are going through an extremely stressful period there, but they're in my opinion, a known risk. What I really feel like is the true risk, and especially to investors, is what I think has been fundamental to the risk cycle since the global financial crisis, and fundamental in carrying the risk cycle since the global financial crisis, and that's the tech sector. To me, to politely disagree with Mr. Levy, whom I really respect, and whose ideas I share, I share a lot with. Really believe in, especially post Keynesian analysis, that the Levy-Koletsky profit cycle equation. It's very heterodox, but but I think it's gaining more adherence because it's been so good at sort of capturing the economy. That digression aside, I think that the boom in the tech sector, and we see it in the market capitalizations of the major tech companies, the FANGs, less so Facebook now, but Tesla, Nvidia, Apple, Microsoft, just the sheer weight that they have in the major equity indices, and then the even below, this last year, the massive boom in private tech startups. Last year we saw a massive IPO boom. Just a myriad of companies IPOing and being taken public through SPACs. I see this as the potential culmination of so-called animal spirits that were driving the economy, in my opinion, since 2009. And I just think that when you look at the valuations of these companies, when you look at the sheer weight of them in not just US benchmarks, global benchmarks, I think on a prospective basis, the risk to financial markets, not so much in the sense of a imminent destabilization, but more so long-term stagnation is retrenchment in the mania that we've seen in the tech sector over the last decade.
Definitely, I think that's definitely an area to keep an eye on. But going back to that idea that you talked about, like the known risks of emerging markets, I think that's really important because, you know, you hear all this talk in the news about, you know, liquidity is lower for right now, and, you know, there's a lot of debt repayment that certain emerging markets have to make. But it seems like these are inherent risks that are kind of baked into the whole philosophy investing in emerging markets. So I'm curious, like, how do you navigate that tipping point of when you feel certain prospects might be too risky? Because after all, the whole proposition, I think, is based on a high risk, high reward model, right?
Yeah, I think there is emerging markets do present a risk premium from those inherent risks, as you say. It really depends. You know, I think in the last decade, sort of maxim I've tried to abide by is emerging markets right now are for trading. They're not for buy and hold. And you want to invest when there's fear, but we've seen pockets of enthusiasm recur every now and then. Even in the last decade in emerging markets, we saw it, you know, the episodes of quote unquote reflation, where you see headlines in the FT, you see headlines in the Wall Street Journal. Is this the final turning point for emerging markets? Is this when and that's when you don't want to invest. And if you just look at the last year, you know, we've seen, you know, where in particular have we seen a really that things go wrong in emerging markets? I mentioned, you know, besides the obvious cases, you know, look at the tech sector in emerging markets. You look at major companies like Sea Limited, Alibaba. You know, really, you know, these were darlings for investors for a long time, and Mercado Libre, and these things have had horrid drawdowns, and it's unclear if they'll come back. On the other hand, you've had countries like Brazil, especially if you're looking to trade, that have done really well. I think Brazil's the best performing market this year, and India's held up quite well as too. It's just that these things you've kind of had to buy opportunistically, especially when you contrast them to something like the FANG stocks, where people have done well just buying and holding over the last decade.
Yeah, definitely. And when you're looking for investment opportunities, how much are you looking at specific companies within a country? Because I know that's like some philosophy that some people use. And how are you like, or do you take like a more macro-based approach and look at the country as a whole?
I very much take the macro-based approach. Whenever, especially in emerging markets, people taking the philosophy of, oh, I'm just going to invest in a good company and let things work themselves out. That's gone horribly wrong. You know, there's rule of law risk. You know, you've seen this with the Chinese tech sector. A lot of investors blindly investing and saying, oh, Alibaba, JD funded solid companies, and then all of a sudden rule of law risk rears its head, and the Chinese government decides that they want part of your equity sector, they want to dictate what your company's going to do, and your multifold gain is at snap of a finger gone. And so I think it's really hard to do that type of investing in emerging markets. Now, that's not to say that you shouldn't use top-down views to pick companies. Every country has essential companies. When I was writing my book, one of the main conclusions I came to is, when you take Econ 101, you learn the perfect competition paradigm. And I think my view of things now is you should look at companies through the lens of East India companies. The major companies in any country are the East India company of a sort. They're national champions. And so when you're investing, sometimes if you can identify systemically important companies, Petrobras, for example, in Brazil, you can find a compelling intersection between macro and bottoms up.
Yeah, for sure. And kind of speaking more generally about these emerging markets, we see that like these classifications of like BRICS, of grouping together these nations like Brazil, Russia, India, China, South Africa as like an entity. In light of like the recent events that are happening, that are transpiring in Russia and Ukraine, do you think that these other nations in this grouping will experience a kind of residual effect from what Russia's going through? Or do you think that they're kind of independent from each other and the grouping itself isn't really that accurate?
Um, Obviously, in the short term, I think just technically and through the market mechanics of especially large institutional investors sort of investing in EM as a monolith, there can be strong correlation. There'll be times where there's high perceived risk in emerging markets, so you'll see correlation, especially times when the dollar index is spiking. You'll see sort of these things being traded collectively. But longer term, I see a lot of dispersion emerging, and a lot of dispersion has already emerged from the so-called BRICS for various reasons, but most importantly, I think geopolitical reasons and geopolitical context. So, China, Russia, we know what's going on in the news. We know that there's sanctions risk. India, I think, is in a very unique spot historically. If you look at India's history through the 1970s, it's been a non-aligned country for a long time, but increasingly that's becoming difficult for India. Right now it's also adhering to its classical, modern non-aligned stance since independence, and it may continue to do so, I think, for even the next few years. But I think, especially given its tensions with China and the US's tensions with China, that's going to be difficult, and I think that will have investment implications. You see some people in the news saying, "Oh, India should be careful. It might be the subject of sanctions because of its lack of its willingness to sort of take a strong stand on this issue." But I just think that the U.S.-India relationship is becoming so essential as time goes on that I actually think it's going to work. I think that will overwhelm any Russia-related sanctions issue, and that has major. Already, for example, you look at, and I mentioned the tech sector earlier. You look at some of the major venture capital firms, especially Andreessen Horowitz. They have major investments in India. And while I think there's some speculative dislocation right now and some Kool-Aid being drank in terms of venture money being allocated to India, I think longer term that trend will remain intact. There is a sort of emerging markets TINA trade. There is no alternative when it comes to India, because when you look at other countries, the sort of institutional backdrop that investors need just India is very imperfect in terms of its because it's a young country, in terms of the institutions that traditionally made investors feel comfortable in developed markets, but they're still, in my opinion at least, far more comforting than those that you see elsewhere in emerging markets. And so I think this is will be a catalyst for continued separation in that BRICS group.
Definitely. And India's kind of been a strange phenomenon this year as well, because even though commodity and food prices are like soaring right now, India recently hit an all-time high in exports of this year. I believe they hit like $670 billion. Do you see this being the case for other economies like Egypt and Turkey that are really heavily dependent on their export markets? Or do you see this as kind of an irregular phenomenon that just happened for India?
No, I think it's a bit irregular in India. I think part of the problem is sort of, I think macroeconomic sample sizes are the macroeconomic sample sizes that people draw inference from are way too small. People look at China and they look at Japan and they look at Taiwan and they say, well, how did these countries grow? They exported. That's the way that that's the model India needs to follow. It's gonna so they're always looking. It's like, this is finally it. This is India's moment. Its exports are rapidly growing. I wouldn't call this slightly contrarian take, but I think there's another route to India's development, and especially when you frame it in this context of this word that's being implicitly thrown out called deglobalization. I think in a world that's sort of a word of reversing globalization, India's path to me is going to be autarky, for better or for worse. And so I'm more of an export pessimist when it comes to India, but that's not necessarily me being a development pessimist. And there's plenty of examples. The US, and actually if you go farther back, the UK, England, before it became the UK, where they were slower to develop than many of their peers, but they pursued this autarkic sort of independent model that eventually did work out for them. And so that's the narrative I still cling to in my head. And we've seen forces behind that. There's this independent India, self-reliant India movement. Again, I say better for worse because I'm not necessarily a fan. I think a deglobalizing world is a dangerous one, but if that is, it is what it is. And in that context, I think the more likely path is, I think this export thing is an aberration. And I think it's just a lot of people trying to cling to this sort of developmental model that we saw in the last 50 years, 60 years, that is still sort of a small macroeconomic sample size in the greater global developmental trajectory.
Yeah, I'm there with you. And also, like, related to like the rise in prices that we're seeing being felt everywhere, the ECB announced recently that they're ending their bond purchasing for the period. The US is considering raising interest rates again. Do you see this as like wise economic policies during this time, or do you feel like they're kind of not really addressing the core issue at hand for obviously like inflation?
Yeah, I think it's extremely misguided. I mean, I can't even. Sometimes I scream in frustration, but the last 6 years, it's like we've learned. It's like the decade of disinflation, of central banks undershooting their inflation targets doesn't matter. It's almost like they're practicing a religion of sorts. This religion of this new Keynesian religion where eventually everything goes towards equilibrium and the economy moves towards full employment. No, I think it's extremely misguided. What I think is happening is that I think central bankers disproportionately focus on the real economy, and despite the mea culpas of the 2010s post-financial crisis, and them saying we really are paying attention to financial markets, we really are sensitive to what's going on in financial markets, I still think they remain wholly a little too ignorant. And I say this because you look at the oil price and the commodity price boom. It's not, we've seen this pattern before. Even when you go back to the 1970s, you look at what was actually going on. What happened in the 1970s? I agree. Many people have already said that the 1970s stagflation analogy is misguided and inappropriate, and I agree with that. But there's actually something interesting that is a parallel, and that's speculation. The 1970s is an interesting phenomenon. You saw the rise of hedge funds. The seminal book, the most important book, in my opinion, written about the history of hedge funds, More Money Than God by Sebastian Mallaby. I encourage everyone to read it. One of the first chapters is on Commodities Corporation, one of the first hedge funds. Soros and Quantum. What were these guys doing? They were levered long commodity futures. You move on to the 2000s, late cycle 2007, 2008, oil is booming. What people, I think central bankers, they don't pay attention to financial markets, but I think you have to ask yourself, stop and ask, why does this happen? And to me, it's because you're at peak animal spirits. I think, it's no different than it's inextricable, in my opinion, from the boom in tech. Just when animal spirits are going, you see rampant speculation everywhere. And that's what I think is driving this commodity boom. And it's a mistake to try to treat it with interest rate increases. And because if you yank hard enough, you might not like the and we saw this during not that I'm saying there's another Great Depression coming, but we saw this in 1929, where if you try to yank hard enough in the other way, the speculative mania will go 180. And in 2007 we saw the same mistake. Right before before the conversation about subprime and Bear Stearns emerging, there was stagflation. If you read the newspaper headlines, people made the same mistake, that they made this so-called category error of confusing this rise in commodity speculation with flight from nominal US dollar assets, which, by the way, is not the opposite of what we're seeing in financial markets. The US dollar has soared. Mm-hmm. So it's a long way of answering your question. I think they're just making the same mistakes over again that they've made. And I mentioned the dollar. People have talked about yield curve inversion, and as someone who's been knee deep in emerging markets, his career, this is not like an emerging market inflationary crisis. I mean, you don't see those countries' currencies soaring in this type of event. You don't see a positive correlation between risk assets and inflation. You don't see stock markets booming. So I hope that answered your question.
Yeah, definitely. I think we can't be this narrow-minded about every single issue that comes our way. Palak, I really appreciate the time today. Thanks so much. And please go check out Palak's book, The Tyranny of the Nations. Thanks so much.
Thanks for having me.